Welcome back to Factor. Pakistan has grappled with economic instability, including high inflation, low GDP growth, fiscal and trade deficits, and a significant debt burden. The country's economy has faced challenges due to an inefficient tax collection scheme, unjust financial distribution model, energy shortages, heavy imports, smuggling, corruption, and a reliance on foreign aid. Let's examine Pakistan's 10 major economic challenges that require immediate attention. Challenge 1: Never-ending debt cycle. Since 2011, Pakistan has witnessed a near doubling of its external debt, alongside a six-fold increase in domestic debt. Consequently, the country faces the daunting task of repaying approximately $49.5 billion in debt maturities, with interest accounting for 30% of this amount. Pakistan's external debt is sourced from various creditors, including the Paris Club, 6.3%, multilateral, 30.1%, other bilateral, 19.1%, commercial banks and T-bills, 4.9%, Eurobonds, 6.3%, the International Monetary Fund, 5.7%, banks, 5.1%, and private sector liabilities, 12.7%. The per capita debt burden in Pakistan has surged from 45,999 rupees in 2009 to 265,579 rupees in 2023, marking a 6 times increase over 14 years. Concurrently, the gross domestic product, or GDP, per capita has declined from $1,295 in 2011 to $1,223 in 2023, signaling a 6% decrease. This imbalance indicates that Pakistan's debt is outpacing its income growth, exacerbating financing gaps and necessitating further borrowing. Debt accumulation has largely been directed towards sustaining a consumption-driven economy heavily reliant on imports, with insufficient investment in productive sectors or industries. Extensive research spanning 44 countries over 5 decades underscores a notable correlation between a debt-to-GDP ratio exceeding 60% and default risk, highlighting the perilous implications for sustained economic growth. In 2022, Pakistan's debt-to-GDP ratio stood at approximately 75%, with external debt reaching $128.1 billion by September 2023. $99.1 billion is the foreign debt of Pakistan's government and state-owned enterprises. In the current budgetary framework, Pakistan aims to generate revenue ranging from 8.6 trillion rupees to 9.2 trillion rupees in the fiscal year 2023-24. However, debt servicing is projected to consume a significant portion of this revenue, surpassing 7.3 trillion rupees, as Pakistan needs to pay $27.47 billion of foreign debt by November 2024. Moreover, substantial allocations are earmarked for defense spending, government pensions, salaries, development projects, and subsidies, necessitating further financing. The government has resorted to daily borrowing averaging 41 billion rupees over the past year to sustain its operations. Consequently, the total government debt has surged to 58.6 trillion rupees, with 36.55 trillion rupees sourced domestically, and 22.05 trillion rupees obtained from foreign creditors. Additionally, 1.1 trillion rupees in subsidies will be financed through debt, ultimately recovered through heightened taxation, thereby burdening the public with increased tax obligations. With more than 80% of bank lending channeled to the government, continuing this debt cycle presents a major risk to public welfare, amplifying forthcoming tax obligations and contributing to inflationary pressures. Challenge 2: National Finance Commission or National Charity Distribution. Pakistan's National Finance Commission Award diverts a 57.5% share of Pakistan's national revenue away from the federal government. As a result, the federal government is facing financial constraints, especially since the revenue streams are insufficient to cover its expenditures and responsibilities. This situation has led to challenges in fulfilling national-level obligations, such as defense, infrastructure development, debt servicing, and other crucial functions typically managed by the federal government. In Pakistan, the distribution of financial resources among its various federating units is a matter of significant concern. Currently, the provinces heavily depend on the federal government for a substantial portion of their funding, primarily sourced from the Federal Divisible Pool. This reliance often gives the federal government an indirect influence over provincial affairs. While Punjab and Karachi collectively contribute approximately 80% of the national economy, with Punjab contributing 59% and Karachi contributing 19%, the contribution of Interior Sindh stands at only 3.39%, Khyber Pakhtunkhwa at 11%, Balochistan at only 5.9%, Gilgit-Baltistan at only 1.5%, and Azad Jammu and Kashmir at a mere 1.72%. Despite this significant disparity in contributions, the regions with lower economic output tend to receive double the amount they contribute to the country's economy, fostering a culture of receiving disproportionate benefits without corresponding economic input. Punjab receives only 51.74% of the provincial share, while Sindh receives 24.55%, Khyber Pakhtunkhwa receives 14.62%, and Balochistan receives 9.09%. Additionally, the federal government allocates funds worth hundreds of billions of rupees from its own share to support the operations of the governments in Azad Kashmir, Gilgit-Baltistan, the Special Development Fund for former federally administered tribal areas, and the Special Development Fund for Balochistan. The NFC formula, rather than considering the economic contributions of the federating unit, relies primarily on factors such as population, 82%, inverse population density, that is, area, 2.7%, and poverty and backwardness, 10.3%, as if the charity is being distributed. Additionally, the federal government allocates 471 billion rupees for the Poverty Support Fund, equivalent to 9% of the provincial share in the NFC. Despite poverty support being essentially a provincial matter, these allocations suggest that the NFC operates more like a charity distribution scheme than a finance distribution award, penalizing earners while assisting spenders. Challenge 3: State-owned white elephants. In Pakistan, there are 88 commercially operated state-owned enterprises, SOEs, which collectively incurred losses amounting to 730 billion rupees, equivalent to $2.61 billion, in the fiscal year 2022, while 50 earned a profit of 560 billion rupees. The World Bank estimates annual losses incurred by Pakistan's 14 state-owned enterprises to be a staggering 458 billion rupees. The 10 most significant loss-making entities, including PIA with losses of 97.5 billion rupees, the National Highways Authority with 168.5 billion rupees, and the Peshawar Electric Supply Company Limited with losses of 102.2 billion rupees, contributed to a total loss of 650.197 billion rupees, equivalent to $2.33 billion. Conversely, the remaining enterprises reported combined losses of 80 billion rupees, equivalent to $286 million, during the same fiscal year. Over the years, PIA alone has incurred cumulative losses exceeding 800 billion rupees, equivalent to $2.86 billion. While the total valuation of the airline's assets stands at approximately 160 billion rupees, equivalent to $572 million. Urgent and efficient decisions are necessary to advance the privatization process. Otherwise, these state-owned entities, often called white elephants, will continue to take large bites from the national treasury. Challenge 4: Circular debt. The relentless challenge of circular debt continues to plague Pakistan's struggling economy. Presently, this issue has inflicted severe damage, with circular debt reaching a staggering 5.7 trillion rupees by the end of January 2024, with the power and gas sectors bearing the brunt at 2.73 trillion rupees and 3.022 trillion rupees, respectively. The gas sector's entanglement in this crisis stems from the underperformance of the power sector. The overall energy sector circular debt now stands at 5.4% of Pakistan's GDP, which goes against the International Monetary Fund's maximum cap of 4% of GDP. As mentioned in Pakistan's $3 billion bailout review, dated November 15, 2023. The increase is roughly 1.5 trillion rupees, or 1.4% of GDP, more than the IMF was promised about. According to a performance evaluation report by the regulatory authority, approximately 66% of this debt is attributed to inefficiencies within power generation companies and independent power producers, IPPs. Circular debt ensues when an entity encounters cash flow challenges, leading to delayed payments to its debtors, creditors, or suppliers. This creates a domino effect, causing problems throughout the entire payment supply chain. The Central Power Purchasing Agency, CPPA, serves as the energy trading marketplace for Pakistan's power sector. Acting as an intermediary, CPPA facilitates the sale of energy from generation companies to distribution companies, collecting payments for the energy units dispatched or distributed. Circular debt, technically speaking, arises from CPPA's inability to maintain balanced cash flows between generation companies and the power distribution sector. Why has circular debt become so pervasive despite efforts to enhance energy efficiency? Insufficient tariffs for end consumers to cover rising generation costs. Systemic inefficiencies within Pakistan's power generation sector. Systemic inefficiencies within the distribution sector of Pakistan. Challenge 5. Power plundering. Pakistan's electricity sector has long grappled with significant challenges, finding itself entrenched in a troubling status quo marked by expensive energy production, strained infrastructure, notable transmission and distribution losses, frequent load shedding, and burgeoning circular debt. This predicament has cast a shadow over the entire economy, plagued by unreliable and substandard electricity supply. In 2015, fuel and operation and maintenance (O&M) expenses accounted for nearly 56% of the total cost, equivalent to 7.53 rupees per unit. In contrast, the share of capacity charges was a mere 2.49 rupees, representing approximately 18% of the total cost. However, the scenario has since shifted dramatically, with capacity charges soaring to 9.77 rupees, now constituting the primary component of the steep tariff rate of 24.82 rupees per kilowatt-hour. Notably, the surge in capacity charges, which amounted to nearly 188 billion rupees in 2013, has skyrocketed to an astounding 1,250 billion rupees, reflecting a compound annual growth rate of 23.43%. Meanwhile, the proportions of variable fuel, O&M, distribution margin, and transmission and distribution, T&D costs, have remained relatively stable over the same period. This dispels the notion that T&D losses serve as the primary drivers behind the escalating power tariffs. Data indicates that the contribution of T&D losses to the tariff has remained stagnant, if not declining. One significant factor contributing to expensive electricity in Pakistan is the independent power producer, IPP deals. IPPs are private companies that build, own, and operate power plants to generate electricity. These deals were initiated in the mid-1990s as part of efforts to address power shortages and attract private investment in the energy sector. Capacity payment to IPP plants is called some sort of evil, especially considering that these plants typically operate for only 100 to 500 hours per year. The concern lies in the significant contribution of these furnace oil-based plants to the energy mix, currently standing at 14% in Pakistan. In contrast, globally, such plants are typically utilized during periods of peak demand and account for a maximum of 4 to 6% of the total amount billed to customers. Overall, Pakistan's energy mix, heavily reliant on expensive fossil fuels combined with contentious IPP deals, has contributed to the high cost of electricity in the country. Data compiled by the Ministry of Energy reveals a stark reality regarding electricity distribution. Most of Pakistan's best-performing districts outside of Punjab are on par with the worst-performing districts within Punjab in terms of power theft. Except for distribution companies in Punjab, Fiscal, JEPCO, LESCO, and MESCO, and YESCO, transmission and distribution losses for all other companies across the country exceed 15%. In the fiscal year 2019-20, these losses peaked at 38.9% for PESCO, closely followed by 36.3% for SEPCO. Conversely, the top-performing companies like FESCO and IESCO have managed to keep losses below 10%. Revenue recovery rates, exceeding 94% for all discos in Punjab, sharply decline as one moves to discos in Sindh, Balochistan, and Khyber Pakhtunkhwa. The cumulative effect of electricity loss and unpaid bills translates into significant annual losses for the distribution companies. Evidence of electricity theft is glaring, particularly in major cities across Sindh, Khyber Pakhtunkhwa, and Balochistan. While pinpointing the exact fraction of electricity lost due to theft remains challenging, transmission and distribution losses surpassing the benchmark set by the best-performing distribution company offer a reasonable approximation. In 2022 alone, transmission and distribution losses amounted to a staggering 520.3 billion rupees, with state-owned distribution companies, excluding K Electric, reporting a loss of 22,298 gigawatt-hours of electricity. Under the current regulatory framework, generation and distribution companies, whether public or private, are remunerated under a cost-plus model, entailing guaranteed margins. However, this setup creates a moral hazard dilemma, as these companies lack adequate incentives to enhance operational efficiency. Consequently, the government and ultimately taxpayers bear the brunt of the disparity between actual provision costs and recoveries. Thus far, we have looked at 5 major economic challenges Pakistan is facing. We still have 5 more to go. If you liked our video so far, please let us know by pressing the like icon and dropping a comment below. Also, if you are new to the channel, please remember to hit the subscribe button and press the bell icon to get notifications. Challenge 6: Rampaging Smuggling. The menace of smuggling has social, moral, and economic repercussions with a greater debilitating impact on the economy of Pakistan. It erodes local industries, fosters tax evasion, and fuels criminal activities, often involving various interests within political and security circles. A joint study conducted by economists from Harvard University and the Ministry of Commerce in 2020 shed light on the pervasive impact of smuggling on Pakistan's economy, revealing that smuggled goods infiltrate multiple sectors, amounting to a staggering $3.3 billion annually. Shockingly, the study found that 74% of cell phones and substantial portions of diesel, engine oil, tires, and auto parts sold in Pakistan were smuggled. Daily influxes of smuggled diesel and petrol from Iran, estimated at 10 million and 2 million liters respectively, incur significant losses, resulting in a monthly deficit of dozens of trillions of Pakistani rupees. Consequently, local refineries operate well below capacity. The study also exposed the dire consequences of dollar smuggling, estimating losses of $150 million per month and an alarming $2 billion annually. Furthermore, it revealed that out of the $7.1 billion gold market, a mere 1.32% is declared to tax authorities due to rampant smuggling, resulting in an annual loss of approximately 80 tons of gold, valued at $500 million. Of particular concern is the abuse of the Afghan transit trade, which bleeds Pakistan's economy extensively. There seems to be some correlation between the surge in transit trade and the decline in Pakistan's purchases. Out of the increase of $2.8 billion in imports under the Afghan transit trade during fiscal year 2022-23, about $2.3 billion was on account of goods that Pakistan did not import, due to the balance of payments crisis. Afghanistan imported $7.3 billion worth of goods through Pakistan in the fiscal year 2022-23. Imports were $2.8 billion higher than the preceding fiscal year. The figure is strange because this rise in imports of Afghanistan is neither plausible nor understandable. The growth of transit import through Pakistan can be attributed to the low volume of imports by Pakistan of the very items that were being imported to Afghanistan. Why did Pakistan import fewer quantities of these goods? Certainly, the goods imported under the guise of Afghan transit trade were illegally offloaded in Pakistani territory and sold at lower rates, as they were not subjected to import duties and sales tax. Challenge 7: No tax culture. Pakistan's tax structure favors regressive indirect taxes, which comprise around 60% of total taxes. Around 70% of direct taxes are derived from withholding taxes. Excluding withholding taxes, the share of direct taxes in total tax collection decreases significantly. Pakistan's tax-to-GDP ratio stood at 10.3% in 2021, lagging behind the Asia and Pacific average by 9.4 percentage points and below the OECD average by 23.8 percentage points at 34.1%. The Federal Board of Revenue, in consultation with the IMF, has set a tax revenue target of 9.4 trillion rupees, equivalent to $33 billion for the current financial year ending June 2024, up from the previous year's collection of 7.1 trillion rupees, which fell short of the 7.6 trillion rupees goal. With over a third of Pakistan's economy undocumented, parallel economies thrive, undermining macroeconomic indicators and diminishing state revenue, only a fraction of which is allocated to crucial developmental projects. The informal economy's persistence serves the ruling elite's interests, manipulating fiscal policies for personal gain. One deterrent to traders or retailers pursuing proper documentation is the prevalence of smuggled goods in the market. Involvement in the illicit trade of smuggled goods circumvents official channels, as these activities evade taxation and customs regulations. The risk of legal consequences further dissuades traders from maintaining accurate documentation, creating a disincentive for legitimate business practices. As of October 31, 2023, approximately 2.9 million tax returns were filed for the 2023 tax year, compared to 2.57 million filed during the same period the previous year, marking an increase of 330,000 filings. In terms of provincial tax filings, the province of Punjab comprises the majority share at 59.84%, surpassing its population share of 51%, as per the 2023 census. Sindh also exceeds its population percentage with a filer rate of 27.34%, while the Capital Territory shows a five-fold increase in filer percentage compared to its population percentage of 0.97%. Conversely, Khyber Pakhtunkhwa, Gilgit-Baltistan, and Balochistan fall below their respective population percentages in terms of filer percentage in the fiscal year 2020. Remarkably, Sindh leads in total tax collection in fiscal year 2020, capturing 44% of the share, partly due to Karachi's concentration of head offices, banks, and the port. Islamabad also outperforms its population percentage due to its status as the capital and the presence of major oil and gas headquarters and corporate offices. Still, Karachi's tax collection surpasses that of other cities in Pakistan significantly. In terms of the breakdown of the total tax collected from major markets, Karachi was ahead with 209 billion rupees collection, followed by Islamabad at 204 billion rupees, and Lahore at 180 billion rupees. Karachi South is dominating every other city apart from the federal capital and Lahore. Karachi East, Malir, and Karachi West all outnumber Faisalabad. Assuming most head offices are in Karachi South, it is difficult to explain why other districts are outnumbering Faisalabad in tax collection. Dera Ghazi Khan has collected more tax than Sialkot and Hyderabad. Karachi is visibly ahead with 85 markets and a collection of over 96 billion rupees, followed by Lahore, Islamabad, and interestingly Peshawar. Among the 19 markets in Karachi that collected over 100 million rupees in the fiscal year 2018, only 5 markets reported collections below 300,000 rupees per filer, which is significantly higher per filer collection rate than other cities across Pakistan. To boost overall tax collection in Pakistan, other cities must enhance their tax per filer to match Karachi's levels. Challenge 8. Real estate or real wealth trap. The World Bank estimates that real estate investment in Pakistan contributes approximately $700 billion to the country's wealth, although some sources suggest this figure may exceed $1.2 trillion. Despite these facts, real estate contributes only 2% to the national GDP. Assessing the true value of real estate assets is challenging due to the undocumented nature of about 80% of the wealth in this sector. Still, the number means that the total value of residential real estate holdings of Pakistanis is equal to 3.3 times the GDP, or the total size of the economy of Pakistan. For context, in the United States, the total value of all real estate in the U.S. is equal to 1.6 times the U.S. GDP. According to a report by the State Bank of Pakistan, the combined contribution of the construction and housing sectors to the country's GDP has consistently exceeded 9% over the past decade. Traditionally, real estate has been perceived as a secure and profitable investment avenue in Pakistan. Population growth, urbanization, and limited investment options have led many individuals to favor real estate investments over financial instruments like stocks or bonds. This investment trend has absorbed a significant portion of Pakistani local savings and remittances into real estate assets, resulting in challenges for Pakistan's industrial sector and stagnation in exports. However, the real estate sector in Pakistan is largely unregulated, which creates loopholes for fraud and malpractices. For decades, the real estate sector in Pakistan has functioned with minimal regulation, resembling the unregulated environment of the Wild West. Developers have employed established strategies to acquire, market, and sell land for real estate projects, often with minimal oversight. A few years ago, Profit conducted an analysis to compare average returns across various asset classes in Pakistan from January 1, 1999, to the end of June 2020. The findings revealed that real estate ranked as the third best performing asset class among ordinary Pakistanis, trailing behind the stock market and gold. Acquiring significant land holdings entails substantial costs and risks. Typically, developers hesitate to fully commit to a new project by purchasing all the required land up front. Instead, they embark on marketing campaigns to promote new housing schemes, leveraging celebrity endorsements and extensive advertising. They offer people documents, certificates, and other marketing tactics that create the impression of purchasing a plot in the future, when in reality, it amounts to speculative betting on the project's success. Data compiled by Profit, using statistics from various government departments such as the Central Bank and the Pakistan Bureau of Statistics, indicates that as of 2021, just over 47.09% of Pakistan's land was under cultivation. Historical data from 1961 to 2021 shows that, on average, this figure has hovered around 47.6%. Notably, there was a noticeable decline in the 8 years between 1982 and 1990. In 1982, the cultivated area had increased to approximately 49.95%, but by 1990, it had dropped to 45%. This decline can be attributed to various factors. Cultivable land is a valuable resource, and its availability is finite. It is imperative to preserve whatever cultivatable land remains, as the total land area of any country is unlikely to expand. Challenge 9: Monopolization and Cartelization. Powerful politically linked cartels in Pakistan have a notorious reputation for manipulating commodity markets by orchestrating artificial shortages through hoarding or similar tactics. These cartels drive prices skyward by deliberately restricting the availability of essential commodities like wheat, sugar, or edible oils, reaping substantial profits while consumers bear the brunt of inflated costs. Once prices have soared due to the manufactured scarcity, these cartels swoop in to import the commodities when prices are lower, typically during the harvest season. This allows them to profit significantly by selling imported goods at inflated rates. This exploitative cycle often persists, enabling the cartels to profit from the volatility in commodity prices continuously. In the aftermath of the devastating floods that struck Pakistan in 2022, the impact on wheat farming led to a wheat shortage in early 2023. Despite Pakistan's annual consumption of approximately 30 million tons of wheat, only 26.2 million tons were harvested in 2022, driving prices up and causing lengthy queues of consumers in urban areas to scramble to purchase wheat. Between September 2023 and March 2024, the Ministry of National Food Security and Research, allegedly in league with the wheat and flour cartel, unnecessarily imported over 3.5 million tons of wheat from the international market, where prices were notably lower. Consequently, by early April of that year, when Pakistani farmers began harvesting their wheat, the national and provincial food storage departments were sitting on a surplus of over 4.3 million tons of wheat. Traditionally, the government purchases around 20% of the total wheat produced by local farmers at a fixed price, roughly equivalent to 5.6 million tons, based on the 2023 yield of 28 million tons. This intervention is intended to stabilize prices, prevent hoarding, and uphold the supply chain. However, this year, the government announced its intention to only purchase 2 million tons of wheat from Pakistani farmers. Consequently, the wheat and flour cartel is estimated to have embezzled approximately 380 billion rupees from the farmers, along with an additional 104 billion rupees lost to the government, intensifying the economic exploitation perpetrated by these influential groups. The wheat and flour cartel facilitated the importation of wheat, resulting in PASCO and provincial food departments being unable to sell their stockpiles of 4,365,220 metric tons. As a consequence, they have incurred average incidental charges of 950 rupees per man, or 40 kilo. Consequently, the total loss to the government due to these incidental charges amounts to 104 billion rupees, which has allegedly indirectly lined the pockets of the wheat and flour cartel. As a result of this unnecessary and unwarranted importation, wheat prices have plummeted to 2,800 to 3,000 rupees per man, compared to the government price of 39,000 rupees per man. Consequently, farmers will be compelled to sell 50% of their estimated total produce of 32 million metric tons, as the government is purportedly purchasing a minimal amount of wheat. Thus, an alleged 380 billion rupees was siphoned off from the farmers, funneling into the pockets of cartels of flour millers, import traders, and bureaucracy. Challenge 10. Trade deficit. For years, Pakistan has been struggling with an expanding current account deficit, presenting a significant obstacle to its economic stability. This deficit arises when a nation's imports surpass its exports, resulting in a net outflow of foreign exchange. One of the principal contributors to Pakistan's current account deficit is the trade imbalance between its exports and imports. The country consistently imports more than it exports, leading to this deficit. A key factor in this disparity is Pakistan's heavy dependence on imports for energy resources and capital goods. Moreover, Pakistan's export portfolio is heavily concentrated in select sectors like textiles and leather goods. This lack of diversification renders the nation susceptible to external shocks, which can further exacerbate the current account deficit. In March 2024, Pakistan witnessed a deceleration in merchandise export growth, slowing to 7.99% after 3 consecutive months of double-digit increases. Despite this, exports reached $2.55 billion, marking a 7.99% increase compared to the corresponding period last year. The trade deficit widened by 56.30% year-on-year to $2.17 billion in March 2024. However, the overall trade deficit for the first 9 months of the fiscal year contracted by 24.94% to $17.03 billion compared to the same period in the previous year. The trade imbalance amounted to a deficit of $17.03 billion from July to March of 2023 to 24, compared to $22.69 billion in the corresponding period in 2022 to 23. Earlier, during the fiscal year 2021 to 22, Pakistan witnessed a substantial surge of 55.7% in its trade imbalance, totaling $48.38 billion. This represented a notable increase from the $31.07 billion recorded in fiscal year 2020-21. Notably, Pakistan's export share in global trade has dwindled over the past 2 decades, dropping from 16% to 10%. Similarly, Pakistan's global trade share decreased from 0.15% in 2005 to 0.12% in 2021. In contrast, countries like Bangladesh, India, and Vietnam have seen their export competitiveness expand. The export competitiveness of Pakistan's food and live animals sector has improved over the last 25 years. However, the beverages and tobacco category lacks export competitiveness. While manufacturing goods exhibited export competitiveness from 1995 to 2014, there has been a decline in competitiveness over the last 5 years, 2015-2020. Additionally, Pakistan shows limited export potential in machinery and transport equipment, chemicals and related products, and mineral fuels and lubricants. Pakistan's diminished export values are attributed to low-quality products and a lack of innovation, resulting in minimal value addition. Furthermore, factors such as terrorism, energy shortages, and a diversion of focus towards non-export sectors like real estate in the past 2 decades have contributed to Pakistan's declining exports and persistent trade deficit. Addressing these economic challenges requires comprehensive reforms across multiple sectors, including fiscal policy, revenue, energy, governance, infrastructure, and security. Implementing effective policies and structural reforms is essential to promoting sustainable economic growth, reducing poverty, and improving the overall well-being of Pakistan's population. In the coming video, we will propose a comprehensive solution to address Pakistan's socio-economic challenges. See you soon on Factor.